Alright, today we got a switch to futures and forwards. The main focus is on futures markets. There will be also some discussion of forward markets. And let's see what we got. So, important concepts here are, this chapter is about the working of the futures and forward markets. There are very little formulas, there's very little calculation. All you need to do is to understand what the market is and how the market works. Again, you can do all the calculations in the world unless you truly understand what the market is. Hey, the two of you guys, okay? The two of you guys, okay? Maybe you have to separate so next time, okay? So, you need to understand the basic definitions. What is a futures, what is a forward, okay? You need to understand the institutional characteristics. In other words, how they trade, where they trade. In other words, what's the market? Whether the market is over the counter or whether they are traded on an exchange. A little bit about what are the types of contracts, which futures contracts are available for trading, where and how you place an order, what is the margin, and one of the main concepts today is daily settlement. What is a daily settlement? If you got a futures, we'll talk a little bit about what is a margin call, okay? The role of the clearinghouse, and the clearinghouse has the same role as that for options, but works in a little bit different way, and accessing some futures prices and quotations, and magnitude and effects of transactions cost. In other words, is it expensive to trade or is it cheap? What is expensive, what is cheap? I've also gotten some website to show you later on, some of the real world, what it is and what it looks like. Alright, let's see what we got here. So, history of futures markets starts way over 100 years ago. It starts in Chicago with the Chicago futures markets. In Chicago became the hub, the center, it's called entrepot, where whatever crops are made, they will be shipped to Chicago, and from Chicago they're going to be shipped to the rest of the United States. So Chicago became the trading center of the United States. And the main concern, the main problem was very simple: price uncertainty. You got a farmer, he's raising corn, or he's raising cattle, or he's raising whatever agricultural commodity might be, and the question is very simple, because agricultural commodities depends on a crop, and a big crop will mean a crash in prices, and a shortage of a crop or a bad weather could mean sky-high prices. Farmers had hard times figuring out what the price would be. The price could be 3 times higher, or it could be literally 3 times lower. So the farmer could be facing a price of 10 times higher, respectively lower, and that meant that with a high price, the farmer would be getting rich, and with a low price, the farmer would be going bankrupt. The two of you guys, yes, the two of you, all right? No more talking, okay? Next time you separate, okay? So, the futures and forward markets began first and foremost with agricultural commodities, because in agriculture, the agricultural markets were the biggest, and they were also the most uncertain. That's where people needed most certainty. From there, you got financial futures. So, in other words, the first markets were what we call commodity futures. From commodity futures, you move on to financial futures. And financial futures will be associated mostly with, of course, interest rates. So you got interest rate derivatives, you got currency derivatives, and you got stocks. Now, the financial futures began their development in the 1970s. And there is an important reason to be in the 1970s. In 1971, collapsed the gold standard. As long as you had a gold standard and currencies were tied to gold, there is no fluctuation between the currencies. There is no fluctuating exchange rates. Gold standard was popular in the 1900s up until World War I. Then there's been a little bit of some problems in between the two wars, and after World War II was established the Bretton Woods system. The Bretton Woods system is based on gold, where the US dollar is exchangeable for gold, and all other currencies are exchangeable for the US dollar. And all other currencies were fixed to the dollar at a fixed exchange rate. So there has been little exchange rate variability. Most countries in the world will be on a fixed exchange rates, and there will be very little currency uncertainty. As soon as the United States became bankrupt and declared bankruptcy in August 1971, because the US had promised for 30-some years that it will exchange its dollars. Hey guys, the two of you, all right? Yes, the two of you, enough, okay? I'm trying to tell you something about futures markets, okay? Right? So, as soon as the US government became bankrupt, meaning it could not fulfill its legal obligations to exchange its US dollars for gold, as it had agreed and as it was customary in the 50s and 60s, the world went on floating exchange rates. And floating exchange rates meant that some currencies will go up, some currencies will go down, and it meant that you had high currency variability. It meant the following, that an importer or exporter may have a profit margin of 6, 8, maybe at most 10%. If the currency goes 6 or 8% against the importer or against the exporter, this basically means that the importer or exporter is losing money due to exchange rate fluctuations. In other words, major exchange rate fluctuations meant extreme uncertainty and risk in import and export markets and prevented global trade from happening smoothly. So there was a major need to hedge currency risk, and that was the early development in the early 70s. Was major development of financial futures was associated with major currency fluctuations and currency risks. Next, during the 70s, because the United States was not on the gold standard and not on Bretton Woods, and the American government could print as much as it wanted, and the American government printed to finance its deficits, its budget deficits. The result was a skyrocketing inflation. In other words, inflation started slowly in the 60s, then it came to accelerate in late 60s, and in early 70s, the American government even imposed price controls. And the price controls didn't contain inflation because the government still kept printing money and the dollar was still falling in value and prices were still rising. The result of rising prices and rising inflation and rising inflationary expectations meant rising interest rates. In other words, interest rates will have two components. The real interest rates, which is very small, and an inflationary component. And as inflationary component rose from 4% to 6% to 8% to 10%, so interest rates would rise. And the rise in interest rates meant that a lot of bonds will be crashing in value, especially the long-term bonds. So suddenly people realized, well, not suddenly, over time, people realized that they needed protection against interest rates. So that over there, the uncertainty and rising interest rates in the 70s, rising inflation and rising interest rates, meant also the development of interest rate futures and also of bond futures, or what are called fixed income derivatives. Okay? Later on, you have the development of options on futures. As soon as you got the futures market and the futures is trading, suddenly you got the opportunity to develop the options market. Options sometimes are helpful in a certain number of circumstances. So options markets also develop, but there has been a parallel development of over-the-counter markets. Over-the-counter markets will be associated mostly with major commercial banks. We call these money center banks. These are the largest commercial banks in the world. Back in those days, investment banks were very small and they didn't play a major role in these markets. Only commercial banks played. Now, investment banks have grown 5 and 10 times bigger relative to where they were. So back then they were not very important. So you have, again, commercial banks began major trading of currencies. And they did over-the-counter markets, and most of these over-the-counter markets will be forward markets. The difference, the main difference between a forward and the futures is that the forward is over-the-counter between financial institutions, or a financial institution and a customer in a direct manner, maybe a corporation. And the futures is traded on an organized exchange with rules and regulations and everything else. So, over-the-counter market began to rise. At first, over-the-counter market was rising faster and had a more rapid growth, but then the futures market began to catch up. The reason was that the banks were first to react to various uncertainties, to offer opportunities to hedge, and later on, as organized exchanges, in other words, as futures markets developed, there were significant benefits to trading on the futures markets as opposed to the forward market. The main benefit of trading on the futures markets, it's a lot cheaper. The second main benefit is that at any point in time you can actually see what the price is. You can observe the price. That's the second major benefit. And the third major benefit is at any point in time you can close out your position. You don't have to hold your contract to maturity. And you don't have to take delivery or provide delivery. So, futures markets have extraordinary advantages over the over-the-counter markets. Okay? So, futures market had a tremendous rise. But the main advantage back then, as well as today, of over-the-counter market is that when you're dealing with a bank, you get a customized contract. The contract can perfectly suit your specific needs. So, each market has its own advantages, and even up until today, 40, 50 years later, each market has grown, and they have grown in parallel. This basically means that each market has its function and serves its customers, and even though they are competing, they can coexist together. Let's see what's next. So, what are the main characteristics of over-the-counter forward market? So, over-the-counter means forward. If it's forward market, it is over-the-counter, okay? So that's very clear. If it's futures and it's an exchange, that's simple to remember. The first most important characteristic is that it's customized. You need the contract for 20 million, no problem. You need the contract for 50 million, no problem. You need the contract for 70 million, no problem. Whatever the size you want, you can get the contract. Next, you need it to be with a maturity of 3 months, no problem. 6 months, no problem. 5 months, 7 months, 9 months. So, very, very highly customized. That is one major advantage. A second major advantage is that it's a private deal, maybe between a corporation like General Motors or McDonald's and a bank. You don't have to disclose it. It's not a public deal, okay? If the public will sense that you're borrowing or having some kind of a major transaction for 100 million or for 50 million, then the public can realize and the market can react to it. Here, over-the-counter market is completely private. Another important characteristic, not sure if it's here, is that you can transact for, let's say, $100 million, or, as it is the case with some derivatives, let's say Goldman Sachs executed certain derivatives, let's say currency swaps with Greece, for a few $billion, okay? So you can make a transaction for $1 billion without moving the market. In other words, you don't have to tell the market that you're making a transaction for $1 billion. Now, you try to buy 1 billion of something, whether it's gold or oil or corn or whatever that might be, you're going to move the market, and you're going to move the market significantly. Here, the transaction is private, and you're not going to move the market. The best advantage which a lot of financial institutions recognize and a lot of market participants recognizes is that this over-the-counter market is mostly unregulated. You can structure the contract the way you want. You don't have to disclose any information. You can do anything you like. You can ask for any type of security if you want, or there may be not any security at all. So the market is basically unregulated, and a lot of financial institutions love that major feature of the market. For them, that's probably the most important feature, together with the fact that most of the stuff is not really reportable. They don't have to report all the stuff that they're getting themselves into. However, one of the major disadvantages is credit risk. Credit risk in derivatives, especially in futures, but also in options, is known as counterparty risk. Counterparty risk means, hey, I'm going to deliver to you, let's say, 500 tons of oil, okay, 500 tons of oil, that's a huge amount of oil, and maybe if things go against me, I won't deliver to you. Or we have a contract, it has to be cash settled. If the stock market goes down 50 points, I gotta pay you, let's say, 20 million, okay? And I decide not to pay. So basically, you have the situation where in a futures or a forward market, one side is a winner and the other side is a loser. Forward and futures markets are a zero-sum game, zero-sum investment. You have two sides, and whenever the one side wins, the other side loses. So you always have a losing or a loser on one side. And the loser may decide that they don't want to fulfill their obligation. This is called counterparty risk and is evaluated as a credit risk. You may have the worst situation where the counterparty goes bankrupt. Even if they want, they can't fulfill their obligation. Now, you may have the counterparty taking so much, we call it derivatives risk, that when the derivatives market goes against them, the derivative market drives them bankrupt. And when it drives them bankrupt, they can't fulfill their obligation. This is all counterparty risk, which is qualified as credit risk. Anytime you enter forward transaction, you encounter or you are facing credit risk. In the futures market, the credit risk, as I'll be explaining later on, is absorbed by the clearing house and the mechanism of daily settlement. The market is huge. When it was written, it's 18 trillion of face value. Probably by now it has grown to 30 or almost 40 trillion. There's been a skyrocketing. Now, at this point, there is a talk, there is a valuation by the BIS that we're talking about 1 quadrillion derivatives, 1 quadrillion of notional or face value of derivative. This means 1,000 trillion of total derivatives. These we're talking about total derivatives around the world, which are both exchange traded derivatives, which are futures and forwards, okay, and includes options. This is specific to the forward market. Since 2001, the forward market has probably grown 3-4 times. So from an estimate of 18 trillion, it's probably grown up to $50 trillion, okay? So that's the over-the-counter market. Futures markets are organized on exchanges. The exchange is usually called a futures exchange. The first original futures exchange, well, modern, we have to clarify. Modern exchange is in Chicago because you have older futures markets. You got in ancient Rome futures markets for, from 2,000 years ago. Then in the Byzantine Empire got futures markets. China had its own futures markets, not so popular. Japan had for a few hundred years its own futures markets on rice, because rice was back then the most important commodity, including money. Rice functioned as money in Japan. So you've had for a long time organized futures exchanges, but the modern one is in Chicago a little over 100 years ago. One of the key characteristics is that it's organized. There is an institution. The institution will provide for developing contracts. So a contract will be what it will be bought, and the contract will be sold. In a similar way to options, when you buy the contract, you're long. When you sell the contract, you're short. The exchange will design what they would believe to be the optimal contract. Optimal contract means a contract which serves the largest number of customers. If you make the contract too small, it's not good. If you just make $1,000, no good. You want to trade with 1 million, you got to be trading thousands of contracts. Not good. If you make the size of the contract to be 10 million, the contract's going to be too big. So the contract can't be too small, and the contract can't be too big. There's what we call an optimal size of the contract. Well, how it's going to be delivered, when it's going to be delivered. All of these we call contract specifications. The contract specifications are also known as terms and conditions. So contract specification will have a number of characteristics. Later on, I'll open up for you the CME, and this is the largest futures exchange, and I'll show you some real-world contracts, what they look like. Part of contract development, and this is very difficult, very confusing, is that you will, as you'll see, you have thousands of different contracts. Thousands, not tens, not hundreds. Thousands of different contracts. I'll show you after the break the contracts at the CME group, which includes a number of exchanges. And you're going to see close to 1,000 contracts only there, okay? And you got, of course, a few dozen of exchanges around the world, which will trade other dozens or hundreds of contracts. So, what are the contract's terms and conditions? The first main one, anytime you trade or anytime you hedge, is the contract size. What's one contract underlying size? For oil, it would be 1,000 barrels of oil. That will be the standard contract for oil. If it's bonds, maybe 1 million worth of bonds. If it's gold, it's going to be 100 ounces of gold. The standard for silver is 5,000 ounces of silver. If it's a currency contract, currency futures, it will be usually worth 100,000 US dollars. So 10 contracts will be worth $1 million. Again, for each contract that you trade, you have to be extremely careful to know what the exact size is. If it's the S&P, you need to say, well, S&P is just an index. So for an index, it could be 100 times the index or 1,000 times the index. For the S&P, the most common one is 250 times the index. Again, well, the number may be by random, it may be historic number. There may have been some reason back in the old days when they put it in. Now, when they have a gold contract, like 100 ounces of gold, for some traders, 100 ounces of gold, let's say $1,000 is $100,000, is too much. A lot of smaller investors can't afford to go for a $100,000 gold futures contract, so they'll develop a mini contract. And the mini contract will be 33 ounces of gold. So the mini contract could be 3 times smaller. You will have, let's say, the silver contract I mentioned already is 5,000 ounces, but the mini silver contract is 1,000 ounces. So it is 5 times smaller. So it is possible that you have, on a lot of contracts which are relatively large, to have a mini. So I have a Dow contract, I have a mini Dow, okay, mini S&P. That's perfectly normal. So they may have 2 sizes, one to fit large institutional investors and one to fit a lot smaller investors. Next tricky part is you need to know the quotation unit. If it's bonds, is it the price of a bond that we quote, or is it the yield that we quote? If it's the yield, how do we quote the yield? There are 2 major ways to quote the yield. You can quote the yield which is as a discount. So you say, oh, it's 4.5%, but 4.5% means 95.5 off the principal. Or 4.5 is an add-on. This is very important for you to pay attention when you're solving the problem, so that when you're calculating, do you calculate 4.5% as 104.5 or as 95.5? There's a little bit of a difference where you add on the interest rate or it's a discount interest. That's something always to be aware when you're working with interest rates. So, quotation unit. Gold will be quoted in dollars. So it's going to be, let's say, $1,330, okay? and maybe 10 cents, and maybe 20 cents, and maybe 30 cents, okay? So here, the quotation unit is dollars, and if it jumps 10 cents, 20 cents, 30 cents, 40 cents, the minimum price fluctuation, which we call the tick will be 10 cents. Now, in silver, let's say the dollar price silver is like $15. So the price of silver is going to be $14.39. And $14.39, the price, the quotation unit is in cents. Okay, the quotation unit is in cents. So $14.39 is the price, but this is effectively cents. This is the same as $14.39. Okay? And here the minimum price fluctuation is 1 cent. Now here I'm going to talk a lot, and I'll be mentioning a lot gold and oil and silver, for the simple reason that back in the old days, 10, 12 years ago, I've traded a lot of gold, I've traded a lot of silver, I've traded some currency contract, so I'm quite familiar with them. As I mentioned, I don't expect you, not me, even top professional futures traders don't know even 10% of what the contracts are. If you have thousands of contracts, you don't expect even a professional trader to know and understand 100 contracts. It's way beyond. A professional trader will understand 10, 20 contracts which they work with. If they are into bonds, they'll understand the bond spectrum, and that's pretty much it. If it's a commodity trader, the guy is going to know 10, 20 contracts. Maybe they specialize in precious metals or in metals in general. Or if they specialize in agricultural commodities, they'll know 10 or 20 commodities and they'll work with them. Okay? And they won't mess with all the others. So when you have thousands of contracts, it's impossible to know even 10%. Ideally, people will know 1 to 2%. They're going to know 10, 20 contracts. I mean, I know gold, silver. I've traded extensively with mini gold, with mini silver. I've traded some with oil, so I understand those. I've traded some with natural gas. So I'm familiar with some precious metals, and I'm familiar with some energy contracts, how they work, and I'm going to show you those. But for each of the others, you can look up the particular contract, and then based on those, you can look up the options on those futures contracts. So, contract grade. Grade means the quality of the underlying asset. For stocks, it doesn't apply. All stocks are the same. For the stock index, it doesn't apply. But if you're delivering or trading in corn, you want to know the quality of the corn. For you, corn is abstract, but you eat everyday rice. So if you're going to be buying 100 tons of rice, right, you want to know exactly what the rice is. Is it white? Is it basmati? What type of rice it is, okay? And then what's the quality? Is it a large grain, a small grain, and all the other things? So you have a detailed specification of the type and the quality of the underlying. Same thing with crude oil. You have hundreds of varieties of crude oil, depending how sour it is, meaning how much sulfur it is, because the quantity of sulfur determines a lot about the qualities, and how thick the oil is, or how thin it is. If it's very thin and pours like gasoline, we call it light. But it may be very, very thick, like asphalt, okay? So if it's thick, it's not light, it's heavy, okay? Well, you don't want to be buying heavy oil, okay? You want to buy as light as possible, okay? So this grade will provide the specification for the type of the quality of the deliverable good. And then there will be discount. If the quality is not perfect, but almost perfect, what's the discount from the traded price? So it will provide all of those things. Of course, anytime you got anything traded, you want to know what's the trading hours. When you can buy, when you can sell. When is the exchange open? Okay. And delivery terms. What is the delivery date? When can you deliver? And you got other little things like notification to deliver or notice to deliver. So if the delivery is in, let's say the contract is December contract, you need to know when can you deliver. Can you deliver on the 1st of December? Can you deliver on the 2nd week of December? And then you need to know what is the delivery procedure, how many days it takes. And if you want to take delivery, you notify that you're going to deliver. You have to notify the exchange. Now, the exchange will have to notify one of the loans. So, first you gotta notify the exchange that you want to deliver. Then the exchange gotta notify the loan, the buyer, that the buyer's gotta take the delivery. The buyer's got how many days, maybe 1, maybe 2 days to make a payment. They're gonna pay the exchange. The exchange will say, yes, payment's received. When they make delivery, they give you the payment back, right? Usually within a day or 2. Again, so you need to know what is the date, what is the time. Well, a simple question. Where do you deliver? Do you deliver in Bangkok or in Phuket, in Shanghai or in Tokyo or in New York, okay, or Chicago? So you need to know where is the delivery. How do you deliver? Or if it's cash settled. Cash settled means that whatever you're gaining or losing on the contract, instead of delivering the commodity like oil or gold or rice, you just pay the cash. Many contracts are strictly cash settled, especially indices. If you're trading an index like an S&P 500, you can't just deliver 500 stocks. That's way too much, way too expensive. It becomes a nightmare. It's almost impossible. So all you're going to do is calculate the profit or calculate the loss, and you calculate the loss for the loser, and the loser is going to pay up to the winner the respective gain and loss. It's a cash settlement. Now, it's important to understand because this is not in the textbook, right? In the real world, a lot of traders and a lot of businesses will go bankrupt. In the sense, they will sell, let's say they're going to sell 20,000 gold contracts. But 20,000 gold contracts is lots of tons of gold. And they won't be able to deliver the gold when the time comes. Okay, that will happen a lot. Well, not specifically with gold, but it can happen in the real world. In that particular case, those who are supposed to deliver can't. And if they can't, they're technically bankrupt. But the exchange will not say that they are bankrupt. They just say, oh, these contracts will be cash settled. And the loser, instead of delivering the commodity, will deliver you the cash. And they call it, it's the same thing. But the problem is that when there is a genuine shortage, it's not the same thing, okay? Getting the cash is not the same thing as getting silver. If you're a silver manufacturer using silver for hundreds of different industrial uses, and you need hundreds of tons of silver, just getting the cash is not the same thing because your production is going to go down. How about this? You guys want to eat rice. How about we settle, your rice contract with cash? Well, you can't eat cash. You want to eat the rice, okay? Same thing, oil. Your buses, your trucks, everything runs on oil, whether it's gasoline or diesel. And you want to buy, the government, let's say you want to buy and import huge amount of oil, you can't just settle. I mean, the exchange will settle because otherwise they got to declare bankruptcy and all the other things. And, the exchange will a lot of times protect the big players. And they're going to just say, oh, cash settled. Every time you hear about cash settlement, you got to know that something has gone horribly wrong with an exchange, okay? But they'll never say that, okay? And it happens quite a lot. Let's see what's next. All right. Usually, futures markets will have a daily price limit. A limit move means, well, the daily limit for gold, we'll take a look, is I'm just picking a number, $100 in one day. So, as long as it goes more than $100 in one day, there is a limit. No more trades above the limit. Or $100 below. You cannot trade below. So, the price stays at the limit. If the limit is above, we say up limit. And if it's below, we say down limit. Okay? Limit down. So, limit up and limit down. So, it just stays there and the market is frozen. What may happen is that in the real world, the price may jump a lot. Something may happen and the price may jump so much that you hit up limit and there are no trades today. On the next day, you got to up limit again. And we have 3, 4, 5 days in a row where hit up limit, no trades, up limit, no trades, up limit, no trades, until the trading price becomes within the range of the market price, and then trades will exchange. So, you may get a very quick move to the up limit, and then for the rest of the day, there is no trading going on. Or maybe you got an up limit and they say 1 hour off, the exchange will not trade, and after 1 hour, it will resume trading. Or it may resume trading after 15 minutes, okay? Sometimes, in the stock market, they call cooling off period. The stock market just shuts down for 15 minutes so that everybody can cool off and they can see what's going on, okay? Because the market can go wild, as you saw, before the break on the flash crash. The market can go wild and crazy, and suddenly a lot of people go crazy. They start doing crazy things, and on top of that, you got machines, the high-frequency traders who start putting all sorts of trades in a desperation, trying to stay dynamically hedged, okay? And the market runs away from them, and they try to keep trading even more and more. So, this is known as, in general term, is known as a circuit breaker. Circuit breaker is an administrative shutting down of the exchange, and the exchange does not execute any more trades for a certain period of time. Maybe the first circuit breaker is going to be 15 minutes. If there is a limit up or another limit is hit, then there's going to be a circuit breaker for an hour. And if the market, after resuming the trading, is crazy again, there may be a circuit breaker for the day, meaning there will be no more trading for the rest of the day. Trying to cool off the market and all those things. So these are defensive mechanisms for futures markets, but as well as the stock market. And circuit breakers were also instituted after 1987 stock market crash, were also instituted for stock markets in the US. And because most stock exchanges starting from New Zealand, Australia, and Japan crashed in October of 1987, most exchanges around the world, including stock exchanges, not just futures exchanges, introduced circuit breakers. Just the market shuts down and doesn't execute anymore, okay? So people can cool off. Because otherwise people can go totally crazy. Now, what we saw during the flash crash, the S&P fall from 1165 to 1065 or so, whatever, about 100 points, meant literally that 80% of all futures traders who were on the margin were bankrupt at that time. They did not have enough margin to cover. So they were bankrupt. So you need these circuit breakers. Otherwise, very quickly, if these traders go bankrupt and they're on the one side of the market, you can get now the broker themselves to go bankrupt. And if the broker goes bankrupt, the member of the exchange can go bankrupt. And suddenly it can jeopardize the whole exchange system. So this is to prevent the little guys from going bankrupt in order to prevent the bigger and the bigger guys going bankrupt, and ultimately to prevent the integrity of the exchange. So, what are the exchange's responsibilities? Well, they got minimum financial responsibility requirements. They got to see what's going on. They got to keep the books. They got to provide data every day. They got to provide prices and quotations and all the other things. The exchange provides position limits. You can't just buy 100,000 contracts of oil, because 100,000 contracts of oil times 1,000 barrels is like 100 million barrels, is way over the world's production of oil. Okay? And if you want to buy 100,000 contracts of oil, you can drive the price sky high. By the same token, you can't just sell 100,000 contracts of oil, because you can literally crash the price from $100 to 60 or 40 or 20. Okay? So, in general, position limit is the number of total contracts, total position, whether it's long or short, that the particular entity can take throughout all of their futures and all of their options positions jointly. Okay? You can't take more than 10,000 contracts. The main idea is that of market manipulation. Market manipulation is when a trader or a business, financial institution, investment bank, commercial bank, starts taking excessive position. They keep buying and buying and buying and buying and buying and drive the market higher, higher and higher. And in this way, with their buying, they can manipulate the market. Or with the selling, they can manipulate the market. This applies with futures because futures have a huge leverage. It should be coming probably in a minute. Huge leverage. And finally, main responsibility is to have rules and regulations about trading. How do you trade? What do you trade? And all those things. All right, there is a table in the textbook. Maybe you can open the textbook. There's got to be like table 8.1. Yes, major futures exchanges. And you can actually take a look. You can open the book. You can see CBOE Futures Exchange, Chicago Climate Exchange, Chicago Mercantile Exchange. Now you can see that you got 3 exchanges under Chicago Mercantile Exchange. I'll open up for you to show you later on after the day. Intercontinental Exchange, Kansas City Board of Trade, okay? Mexican Derivatives Exchange, Montreal, okay? In Asia, you got Central Japan Commodity, Hong Kong Futures Exchange, Kansai Exchange, Commodities Exchange in Japan, Korea Exchange, Malaysia Exchange, National Stock Exchange of India, Shanghai Futures Exchange, Singapore Exchange, Tel Aviv, Taiwan, Tokyo, and so on, okay? So, you can see you got plenty of exchanges around the world, okay? And the estimated worldwide contract is whatever. All right, who are the futures traders? No, in other words, who trades on the futures markets? And they got a large number of different classes of traders, and the classification will be depending on different things. For example, will depend on trading strategy, will depending on what is your relationship to the exchange, okay? So, you got all of these. Futures, commissions, merchants. So, you got a futures, commissions, merchants, okay? Will be simply brokerage firms. Brokerage firm will be simply called, technically, a futures, commissions, merchant. That's the brokerage company. Now, locals will be those that trade usually on the floor of the exchange. These will be sometimes market makers, sometimes specialists, depending on which exchange, what design it will have, market makers and specialists. These will be locals, and the locals trade for themselves. So the main characteristic of a local is that they act as dealers. They buy for themselves for their profit, and they sell for themselves for their profit. So, dealers act on their own behalf, and all the profits and all the losses accumulates in their account. The futures commission workers are brokers. Brokers don't buy and sell for themselves. They buy for other people. A broker's income is based on a commission, usually $10 a trade or $20 a trade, or it will be $10. It's called a round trip trade. A round trip trade means the trade of buying a contract and then selling it back, or of selling a contract and buying it back. We say it is of opening a position and then closing back the position. So usually a commission will involve both of them, both the opening and the closing part, and they'll charge you upfront on the opening. Whenever you open a position, if you're buying a contract, they'll charge you the commission, and when you sell, if it's a round trip commission, the sale is already included in it. Okay? And you also have dual trading. Dual trading has been extremely controversial in America. These are people, participants on the exchange, that are both brokers and dealers at the same time. In other words, they deal for themselves, but at the same time they're also brokers. Well, what's the problem with dual trading? What's the problem when you trade both for yourself and for others? And the problem is known everywhere in the literature as front running. Front running means that when a customer comes and says, I want to buy, let's say, 5,000 contracts of oil, you know that 5,000 contracts of oil will drive the price higher, and you buy before them, maybe 500 contracts, and you keep selling to them, and as they keep buying, the price goes up. And when the price is sufficiently up, you already sold, let's say, 4,500 contracts. The last 500 contracts, you'll sell your own. So, you buy the contracts when the price is low, as they keep buying and buying and buying, because they gotta fill 5,000 contracts. And there won't be anybody selling the 5,000 contracts. They're gonna buy 100 contracts at this price, they're gonna buy 200 at this price, they're gonna buy 500 at this price. So as they keep buying, buying and buying, the price is gonna go up, up and up. And close to the end of their order of 5,000, when the price is already up somewhat, you're going to sell them your contracts and you're going to make a very quick profit. It's called, this is in the United States and in most exchanges around the world, this is illegal. So front running is illegal. It is the practice of buying when a new order comes, to buy before the order is executed, and then sell after the order is executed, or sell at the very end and make a huge profit. This is illegal, okay? This is a really, really bad practice, but it's done practically everywhere in the world. Why? Because it's quick money, it's very easy money, you can make the profit usually within seconds, at worst case 1 or 2 minutes, usually 10, 20, 30 seconds, you can make the profit, okay? And it's like a sure thing. Hey, you can make a few $100,000 in a matter of half a minute. They make it, okay? But it's illegal. So dual trading has got the problem of front running and other issues. In other words, the trader will first defend his own interest and will profit at the expense of the customer. Okay? Next one, classification by trading strategy. You have hedgers and have speculators. Hedgers are those that try to reduce their risk. Speculators are those that will assume and increase their risk. A lot of times the speculator will a lot of times be more and better informed, or a lot of times the speculator will be more and better capitalized. But you may have small speculators. Small speculators have very little capital. They're not professional. They don't know exactly what they're doing. They'll speculate on the market, and they will sometimes very quickly lose their money. So speculator is not defined by the size. They're defined by the fact that they assume risk. They take the risk. They're the risk takers. Okay? Spreaders, spreading in futures is pretty much the same, and it's exactly the same concept as spreading in options. Spreading in futures means you sell 1 month contract and you buy another month contract. So in a spread, your net position is 0. The difference is you're long 1 month and short a different month. That's pretty much it on a spread. Here you don't have strikes. Here you got only time. You got September, October, November, December contracts. And finally, you got arbitrageurs. And arbitrageurs are traders who look for arbitrage opportunities. When they see an arbitrage opportunity, they immediately execute the buy somewhere and execute the sale on another market or another product, and they try to lock in a guaranteed profit, a guaranteed gain, which as the contracts move on with time, they will pocket the difference, the arbitrage profit. By trading style, so the classification continues. Some will be scalpers. Scalpers will try to buy very quickly and sell just as quickly. The way to think about scalpers is they hold the position for a minute or two, maybe 5 minutes at most. A scalper will rarely hold a position for more than a few minutes. They try to exploit and see what's happening. They see a short-term trend. They see the price moving up. They try to buy, and 3 or 5 or 10 seconds later, they try to sell just a little bit of a price. So they hold for a very small period of time, for a very, very, very small profit, for a very small, we call it gain, okay? And they can execute hundreds or maybe thousands of trades per day. Then you got day traders. Day traders will usually assume position during the day. They will maybe buy, maybe sell, maybe buy a few more contracts, maybe sell a few more contracts. Maybe they're going to be long in the morning and short in the afternoon. But the golden rule of day trading is that you never leave a position overnight. You never leave an open position at the end of the day. So day traders always close their books. They always close all of their contracts at the end of the day. A day trader will be watching the trading. He will have a very clear idea of what his risk positions are, of what is his risk tolerance and what is his risk limit. And if the price goes through a certain level, they're going to buy, they're going to sell. In other words, they say, hey, I'm buying gold and I'm not going to take any more than $5 loss. So they buy for $1,300. If it falls to $12.95, they're going to liquidate the contract. They're going to close the position. So day traders, no matter what happens, a few minutes before the trading ends, they always close their position. Because it is considered that when the trading is open, you will have only small movements and they're going to be able to react within seconds. When the market closes, you can have huge announcements like Fukushima. Okay, you got a war going on somewhere around the world. And by the time the next day it opens, the trader may suffer tremendous losses or literally be bankrupt. Okay? Or you may have an overnight trading on some other market around the world. Because if it's gold, gold will also trade on other exchanges, including in Shanghai, including in Singapore, including in Tokyo, and of course in London. So by the time you wake up, you say, oh my God, I'm already bankrupt. And position traders. Position traders will hold a position usually for a couple of days, usually maybe for 2, 3, 5 days. I have been mostly a position trader and what is known as a swing trader. A swing trader will try to catch an intermediate move on the way up or on the way down, usually for a couple of weeks. So a position trader will hold from 1 day usually to about 1 week. And a swing trader will hold usually from a couple of days to a couple of weeks. So a swing trader will hold from 3-4 days maybe to 3-4 weeks, up to maybe a month, maybe 2 months, trying to exploit an intermediate trend. Next one, off-the-floor futures traders. So you have on-the-floor futures traders and off-the-floor futures traders. Individuals like me. You know, I trade a contract here and a contract there. I did trade for about maybe 6, maybe 7, maybe 8 years. But when you're trading, especially futures, you lose sleep. When you're trading futures, at night, when you wake up, you go and check out what the price is, because things may go wrong during the night, during the overnight trading. So you may have, of course, institutions, pension funds, corporations, mutual funds, insurance companies, all of these will trade over there. And there are some others. Introducing broker. Introducing broker will be, for example, you contact your local broker over here, and your local broker will hook you up and will execute trades for you on the, let's say, CME. But all your introducing broker will do is when you have a trade with him, you want to buy a contract, your broker will contact the broker in Chicago or the broker in New York. So he will be an intermediary broker. You contact a broker, your broker will pass your trade on to the other broker, and the other broker will execute the trade for you. So this is known as an introducing broker. If you're opening an account here, let's say futures, you're not likely to open an account directly with the CME. You're going to open an account with a local broker, and your local broker will work with some big broker on the exchange. You're also going to have commodity trading advisor. These are usually businesses who will only provide advice. They'll tell you when to buy pork and when to sell corn and when to buy oil and when to sell silver. They're going to tell you based on their analysis. They provide analysis. You have commodity pool operator. And a commodity pool operator is kind of like a mutual fund, but the big difference is that mutual funds are prohibited from trading highly risky instruments. They are prohibited from trading with leverage. They're prohibited from trading on futures and options. So these commodity pool operators are like a mutual fund, but they are not a mutual fund. They are considered high risk investors. Their returns are highly volatile. In a month, they can easily make 10 or 15% profit, or they can make 20 or 30% loss. Okay? So these are extremely risky operations, and they are allowed only for qualified investors, investors who are sophisticated and rich, for example, who have wealth of over $1 billion US and whatnot. And associated person, I don't want to do with that. Let's see what else we got over here. Futures traders. Okay. A seat means being an owner of the exchange. So, to have a seat, to own a seat means that you're an owner. And the owners are called members. And the members will own a seat. Means you can trade directly on the exchange. So what you can see, and you got a little nice picture over there, maybe let's see what's the picture name. Monthly seed prices, seed from 96. That's figure 8.1. You can open your book on figure 8.1 and tell them what the price, what the page is. And you can see how the price fluctuates up and down, and the price fluctuates with the expected profitability. It is an asset like any other asset, and if you expect high profits because of high trading, the price is going to go up. And if you expect low profits, the price is going to go down. And you see that it ranges anywhere from a quarter or a third of $1,000,000. It trades to over $1 million. So you want to become a member of the exchange, $1 million US, you buy your membership. Leasing, you can also lease it. Leasing is the same as a rent. And you pay about 1 to 1.5% per month of the seed price. 1.5%. Is this a good investment or not a good investment? So if you bought it, if you bought the seeds and now you lease it out at 1.5%, is this a good investment or a bad investment? I already see people asleep. Welcome. Yeah. 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 Is it a good or bad investment? Is it a good investment or bad investment? In the real world, you rent it out, meaning you lease it out at 1.5%. This is a good investment or a bad investment? I guess I need to grab a chair. I need to grab a chair, right? This is a good investment or a bad investment? 1.5% per month of the seed price. Is this a good investment or a bad investment? What's the model say? You got a theoretical model. When you develop it and crank it out, well, what does it say? Good or bad? Huh? Would you invest in a seed like that?
No.
Why not?
I think it's too expensive.
Okay. What do you think? No idea. Wow. No idea. Now that you wake up, is it a good or is it a bad? Maybe good. Why maybe good? Why maybe good? Right? We're talking about, right? Why maybe good? Good or bad? Good or bad? Huh? Bad investment. Why bad? What determines an investment? What determines an investment, good or bad? What's the main determinant? Hey, that's the real world, guys. In the real world, you rent it out for 1.5% of the price per month. Good or bad? Not sure. Yeah, I know. Maybe good or maybe bad? Bad. How bad? Like really bad? Isn't it just better to buy a condo, right? You know, across the street. Okay. Question: is it better than a condo? Yeah. Is it better than a condo? Is it better than a condo? How much a condo make? Well, it says 1.5% per month. It already says. Yeah. Hmm? Right, but this is leasing a sequel. You rent it out. You rent it for 1.5 months, 1.5%. Yes. Well, it's the same thing. You rent it out for 1.5%. So it's a good investment. For fun. Huh? Good or bad? Bad. Again, good or bad? This, guys, is a fantastic investment. This is an investment you can possibly dream in your life, you're not going to realize 1.5% per month. Kind of like guaranteed, because you lease it out, means on a compound interest 20% a year. 20% a year is a dream investment. Any investor would love to invest for 20%. You invest in a condo, if you're lucky, you're going to get 5%. If you're lucky. Because most investors won't be lucky. Most investors will lose money when investing in real estate. Okay, that's what we're going to discuss next weekend on risk management. Okay, this is a fantastic 20% return. You can't get it, you know, with little risk. You lease it. You got a contract, and the guy will pay you every month 1%. 1% translates to 13%, 14% annually. 1.5% translates to close to 20% annual yield. You invest in a bond, you're going to get 1.5% per year. Okay? You invest in a bond, you're going to get 10 times less. You invest in a stock, on the average, stock will give you 3, 5, 7%, annual both yield and return. This is a fantastic investment if you can make it, okay, 12, 15%. Because it simply says leasing it at the seat price. So whatever is we call this the current yield. Current yield is how much you earn today at today's price. So you invest in a condo in the bubble environment today, you're going to get 3%, 4%, 5%. Here, it's 20%, okay? In a condo, you're earning 3 or 4% yield, and you're paying interest rate on a bank, how much? 6, 8%? How much you pay for a mortgage on a condo here? What, 6%, 8%? How much you pay? So, you're having a negative yield on a condo. You're making 4%, you pay 6%. We call it a dumb investment, right? It's a guaranteed loss, right? Well, if it's a guaranteed loss, why people will buy a condo if it's a guaranteed loss? Why would they do that? You get 4% income and yield, and you pay 6%. Why would you lock yourself into a guaranteed loss for a long time? Why would anybody do that? Why everybody's doing it? Why? Because they expect the price to go up. And they expect to get a capital gain. And when everybody is investing because they expect the price to go up, we call this a speculation. And when everyone's doing it, it's a bubble. Okay? One way to define a bubble is by the yield. If the yield is less than the interest rate, is one of the many definitions of a bubble. And when you got a bubble, we know for sure what's going to happen. The first you exit the market early, which sell, the first 5 or 10% are going to make some money. And the 90% who stay with the market are going to lose money. All right, so that's a great investment right there. Time to take a lunch break, and then we're going to continue. Mechanics, okay. Is it 1 hour? 1 hour lunch break? Okay.